Welcome back to Behavioral Finance and FinTech. I'm Andy Kim, your Dr. Finance, and today I'm going to talk about the characteristic effect of the stock market or your asset market, which is evidence against semi-strong form market efficiency. Why is it semi-strong for market efficiency? What is semi-strong for market efficiency? All the public information, publicly available information is already priced in your asset or stock so that you cannot make money simply based on the strategy using those public available information. When you say publicly available information, you may have some first impression about the accounting numbers, right? Earnings surprise or any kind of, whatever you learned in accounting basics, right? For example, how the company manages their inventory, like LIFO, FIFO, LIFO reserve, and all this kind of complicated stuff, or deferred tax asset, deferred tax liabilities, or profitabilities, right? Gross profit or ROE, all these kind of things pop up in your mind and boggles up. All those publicly available information getting priced in real time. But come on, the evidence against this, right? For this evidence against this, you don't need to go that far. I say the simpler evidence takes you a long way. The simpler evidence, the most publicly and apparently available information, very visible, is the company's size. Big company versus small company, market cap, right? It's available real time. 시가총액, you can see that, right? That's number one, size. And the second part we're going to go through is something called book to market, BM, not BMW, right? Not Bayerische Motorenwerke, but book to market. Book to market of what? Equity, right? So equity side, book value versus market value. So book value over market value of equity. 시가총액, right? Market value, and then 자본총액, right? In Korean terminologies, right? The book value of equity, market value of equity. Well, isn't that a flip side or the inverse of something called the price to book ratio? Exactly, yes. And this is also available real time. It's visible right away. How many times PB ratio is it? Depending on the PB ratio, you classify the companies into growth stock versus value stock. And then Warren Buffett's idea is put your money into the value stock where the PB ratio is really miserably low, right? That kind of value investing strategy goes together with this book to market number, right? Why do we use book to market instead of price to book ratio? I'm going to come back to this idea later on. But what I want to highlight is that the size and book to market, such a vivid and apparent publicly available information, okay, is already priced in the market versus not, okay? According to semi-strong for market efficiency, such an easy, visible numbers, right? Those information should have been priced so that you could not make money based on those investment strategies based on these numbers, size or book to market. But the researchers found out that you still can make money based on simple trading strategies based on these size or book to market. That's a clear evidence against semi-strong for market efficiency. That's behavioral finance guys' argument. So let's go one by one. Here, characteristic effects. Yeah, the size or book to market or whatever, it is a characteristics of the companies. Now, common questions is that can publicly known firm characteristics be used to predict abnormal returns in the cross section of the stock market? Okay. Then the two characteristics discovered to be useful is size and book to market. By the way, what do you mean by abnormal returns over here? Abnormal, something not beyond what is expected. Okay, so that means abnormal means we are starting with some kind of a normal returns. Normal returns. What is it? Expected returns or required rate of return that you estimate using the asset pricing model or discount rate model, risk return trade-off. Do you mean capital asset pricing model, CAPM? Yes, we need a benchmark risk return model to calculate the normal return. By that, once you have those normal return benchmark, you can calculate the abnormal returns using your strategies of using size or book to market. Okay, and test whether this abnormal return is different from zero. Remember CAPM discussion before, CAPM refresher, I talked about the alphas, right? Alphas. Is that alpha equal to zero, null hypothesis, or different from zero, alternative hypothesis? That's what we test, all right? Abnormal return being significantly different from zero or not. So size, market cap, price times share number of shares outstanding, that's obvious, right? And then the book to market ratio is 1 over price to book ratio. Korean guys always say PBR. I don't know where that R, why do you have to, place that R over there, but American guys, they use it PB and flip it. Now, I'll get back to this idea, why do we use the inverse of it, but let me talk about the size effect first, okay? Size effect and book to market, all these things are basic building block of quantitative trading, something called quantitative trading. Isn't it finance quantitative anyway in the first place? Nomenclature-wise, that's kind of, yeah, you're right. But why do they call it quantitative? Because to me it's like as opposed to Warren Buffett's idea about the studying one or two stocks in depth and then figure out their fundamental values in using DCF, spending years or months in studying just one company or one industry, right? Forget about that part. Quantitative trading suggests you to just sort the thousands of stocks using very simple criteria. For example, last time momentum was what? Sorting all those companies based on the past return history. Winners all the way down to total losers. And then pick the 10 percentile, 10 percentile. Long, short. Right? That's one quantitative trading strategy. Did you ever ask for each individual company's, how is the CEO doing? Got the COVID-19. Did we ever care about that things? No. Here, size is the criteria we're going to use it to sort those thousands of companies. Either it could be in the US market or in the Korean market, right? Just list them up based on the market cap. Small stock all the way down to big stocks. All right, big stocks. And then never ask for, whether they had some kind of labor union issues or whatever issues they had, right? Did the CEO smoke a crack or something? No, we don't ask that kind of things. Just list them up. 단순무식 in Korean terminology. All right? Perfectly like engineering guys, 단순무식해요, right? And then, so just list them up. And this is why the engineering guys are so thriving in finance as well. They don't care about the details about it. And then just list them up and pick up, okay? And then trade based on this size category. How do you do it? We're going to talk about it in the next slide, a couple of slides later. And the thing is, okay, as it turns out, the financial economist, right, and the behavioral finance guys found out that those small companies tend to outperform big companies so that you can make money, right? If you short big stocks and then with that cash that you got up front, you take a long position of the small stocks, okay? It's a long short portfolio, small minus big, right? That will be your size-based portfolio. The thing is, size is such a vivid and apparent, the publicly available information. The market efficiency says that you should not be able to make money based on those size trading strategy, but you can then you can, right? Right. So that's what the size effect is about, right? The thing is size effect explained by, or is it because the small companies are more vulnerable during the economic downturn, like recessions? Is it because the small companies are more likely to go bankrupt and then die out during the bad times, whereas the bigger companies can, thrive and then persist? If that is the case, right? If that is the case, those market beta in CAPM will capture that kind of business cycle effect, so that your normal return will capture that part, so that nothing will be left as abnormal return, nothing will be left as alpha, as long as you use CAPM as your benchmark return of your portfolio strategy, size-based portfolio strategy. That's what the neoclassical economists say. Those things should be already explained by those market factor, one factor, right? But the results tells us that it is not. It is not still captured by that. Very strange. Very, very strange. What does size have to do with this risk? Size effect, turns out it is closely related to January effect. Small stock outperforming big stocks, much more pronounced, much more drastic in January times. Okay, that's what I'm talking about here. The debate is this: the debate between the neoclassical versus behavioral finance guys. Neoclassical guys say, a behavioral finance guy would say this is a clear evidence of mispricing. Okay, as I said before, neoclassical finance guys say you must have found out another systematic risk factor that is not clearly explained by the existing risk factor, CAPM risk factor. So what kind of risk is it? We don't know, but let's just label it as size. Bring a second risk factor over there. Okay, that's their argument. And then the table over here, what this table tries to show is that the size effect, the small companies outperforming big companies, is not explained by CAPM beta. Okay, CAPM beta. You see on your vertical axis, you see 10 different portfolios, small company to large company, 10 deciles, and their returns over here. Okay, their returns in percentage point, and then you can see that clearly small stocks outperform big stocks, large ME market equity, right? And then it is rather monotonically decreasing, right? Well, is this a function of, explained away by market beta? For example, small companies today systematically have higher betas, and then big companies today systematically have lower betas, and as it turns out, it's not. Regardless of the beta quintile, what you see on the the horizontal axis is the decile of betas. 10분위 수, right? 10분위 beta. You just 10%, lowest 10% up to highest 10% beta group. You form companies into these 10 deciles of the betas, right? Low beta group, and then sort them into small to big companies in respective beta categories, and see whether these beta for the small, the returns for the small companies to big companies, that difference disappears somewhere. As it turns out, it does not disappear. The difference between the small to big companies persists, right? Regardless of the market beta group in CAPM, regardless of those market risk, right? Those size effect is prevalent, persistent. So it's not explained by the CAPM factor, CAPM market risk factor. So that's a size-based story. Characteristic effect is there. That is something not explained by CAPM model. The second is book-to-market effect, BM, right? Book-to-market effect firms with high book to equity, okay, BM, by the way, I said this is inverse of PB ratio. Remember PB ratio? Well, the higher P ratio means growth stock. What is PB ratio? That's for each dollar that you invested as your equity holder, right? How much does the market evaluate today? As equity holders, historically they put in $1. Today, let's see how much they evaluated. If you look at the PB ratio of, let's say, conventional banks like KB, Gukmin Bank, or some whatever conventional bank you want to name it, right? JP Morgan maybe. PB ratio is less than 1. Makes you regret as a equity holder. Why did I ever put my money? Okay, given that $1 that I invested, now the market tells that they're not going to buy it at $1, but something less than that. Regret. In contrast, for Tesla kind of companies or Kakao Bank kind of fintech companies, let's say, PB ratio is like more than 40 times or something. No, not 40. More than 5 times or something. For each dollar that you invested, right, as an equity holder, the market now evaluates that as more than $5 or something. You're happy, higher PB ratio. Why do they evaluate highly? Because of the growth prospect, okay? Growth potential of the company is so big. 성장주. So PB ratio very big. On the opposite side is what? The value stock, right? That's the difference, right? Value stock, low PB ratio. Now take the inverse of it. That's book to market ratio. So high book to market means value stock, low book to market means growth stock, right? And then the researchers found that these value stock tend to outperform these growth stock. If you look back in history, okay? Oh, that's quite opposite to what's happening right now. If you look at the stock market today, right? All those Naver, Kakao, of course, the Kakao may be an exception today, but those game stocks or kind of tech stocks, right? Evaluated highly, so it seems like they are performing very well these days. Well, that's partially because we are in the bubble period right now, but over long time horizon, okay? These guys, growth stocks don't perform that very well. Instead, what is interesting is this value stock, supposedly depressed ones, outperform. Perhaps they are discounted too much, okay? That's an interesting finding, right? Is that a function of, is that it already, is it because the value stock has a higher market risk? Then the answer is no. The CAPM market risk, right? Market risk does not explain away this book to market effect. Clearly, there seems to be something independent risk factor that you may have found out, or you may have found out some clear mispricing. Okay? So inverse price to book ratio, yes. The denominator, what if it goes to 0? Yeah, so instead of price to book ratio, which is prevalently used in the industry, why do academicians use book to market ratio? Is it because the academicians want to distinguish themselves as somebody else, a superior human being? No. Price to book ratio has some problem with it. Why? It has to do with the denominator problem. Price to book ratio, 시총, and then the 장부가액. If you look at the distressed companies, right? Or loss-making company for whatever reason, 쿠팡 kind of guys, maybe. They make a loss in the beginning of the period, okay? The young companies with a lot of investment, but still don't make money. Amazon in their early period. Coupang maybe right now. But the thing is, they tend to, if they keep on losing money for a long period of time, what happens to their book value of equity? Becomes 0 and then goes to negative, right? What we are worried about is the situation of the book value being 0. The denominator being 0 explodes the whole number of price to book ratio. whatever price that you have as a market cap, whatever small number you may have, doesn't matter. If you divide this guy by 0, it will explode to infinity. So you will not be able to study in a statistically rigorous manner. So let's flip it, okay? So that let the numerator go to 0, fine. The denominator, market value of equity, never goes to 0 as long as it is launched and then traded in the market. Because Robert Merton's 1973 idea that the market value of equity cannot be 0 or cannot be negative before the, how do you say, 청산한다. It's like a clearing, liquidating, before liquidating your companies, right? That will not happen. Market value of equity will always be positive. So book to market ratio is safe in that sense, right? It does not explode. Negative book to market ratio can happen, but for that negative book to market ratio companies, forget about it. Okay, we just eliminate those in our study. Okay, don't ask me why, because just the academic convention has been happening that way. It's usually distressed companies, and then you don't put your money in those companies as an asset manager. Usually private equity companies will get in there and buy out somehow or just liquidate the company, right? So forget about that part. But that's book to market ratio, and then they found out that this kind of book to market strategy, okay, value strategy, I say, gives a better return. That is not explained by cap and beta benchmark, right? It's consistent with the value investing idea of Warren Buffett, right? Warren Buffett, what's his idea? Well, look at those value stocks whose book to market ratio is high, which means price to book ratio is very low. Okay? POSCO kind of companies, Coca-Cola kind of companies that have a lot of assets sitting in their balance sheet already. Assets in place, right? Those companies seem to be unduly discounted too much like too much discounted, right? So that it's a good buy. And then pick up those undervalued stocks. And then if you hold it for long, then you will see that the portfolio outperforms. That's value investing strategy, and that is precisely what this is capturing it. So in the next, so wait for the next video, and then I'm going to talk about the performance of this size and book to market as we go down to the back testing. Thanks for watching.